They didn't ring a bell. There was no breaking news banner on your television, no emergency alert on your phone. But while most of the world was sleeping, silver quietly stepped over a line that was never supposed to be crossed. $75? Not traded, not tested, not teased. Gapped. One price, then suddenly another with nothing in between. No liquidity, no sellers, just empty space where the market was supposed to exist. That kind of move doesn't happen in healthy systems. It happens when something underneath has already broken. And the most dangerous part? Almost nobody is talking about it yet, because what you are watching right now is not a rally. It is not speculation. It is not momentum trading or social media hype. This is a structural shift that has been building quietly for years, and overnight, it finally revealed itself. The price didn't climb to 75. It jumped there as if pulled by gravity from the future. That's how you know this is different. When markets move normally, they negotiate. Buyers and sellers argue. Price inches forward, pulls back, tests patience. But gaps don't negotiate. Gaps announce absence, absence of supply, absence of trust, absence of control. And once a market starts gapping higher, the next move is never small. This is how the final phase begins. Think back to every major commodity shock in history. The moment everyone remembers is never the beginning. It's always the explosion at the end. But before every explosion, there's a quiet moment when the market stops behaving the way it used to. When prices stop responding to logic, to news, to fundamentals. When the old rules simply stop applying. Silver just entered that moment. For years, you were told silver was boring, too slow, too manipulated, too small to matter. Analysts dismissed it as an industrial metal with limited upside. Bank reports lumped it in with copper and zinc. Commentators laughed at the idea of triple-digit silver, calling it fantasy, conspiracy, or nostalgia from the 1980s. But markets don't care what people believe. They only care about flow. And right now, the flow is screaming something that words cannot contain. Because here's the truth nobody wants to say out loud. The silver market has been running on borrowed time. Every ounce delivered over the last decade has depended on confidence rather than availability. Paper promises instead of physical metal, rolling contracts instead of real settlement. For years, that worked because most participants never asked for the metal itself. They just wanted exposure, a price, a number on a screen. That illusion is gone now. The overnight gap to 75 wasn't caused by a headline. It wasn't triggered by a speech or a data release. It happened because somewhere in the system, someone needed real silver and couldn't get it. And when that happens, price doesn't move gradually. It reprices violently. Imagine walking into a store expecting shelves full of inventory, only to find them empty. You don't negotiate with the shelf. You pay whatever the remaining seller demands. And if there are only a few sellers left, the price doesn't rise. It jumps. That's what happened here. And once the market exposes that weakness, it can never go back to pretending everything is fine. This is why the 75 level matters so much. Not because it's a round number, not because it looks good on a chart, but because it represents the moment the market admitted, silently, that supply is no longer elastic. For decades, silver supply was treated as if it could expand on demand. Higher prices would bring more mining, more recycling, more availability. That assumption is baked into every model, every forecast, every risk assessment used by institutions. But reality has been drifting away from those models for years. Silver production hasn't meaningfully increased despite rising demand. New mines take a decade to develop, and most silver isn't mined on its own anyway. It's a byproduct, tied to the economics of other metals. You can't just turn a dial and produce more silver because the price went up. At the same time, silver consumption has changed in ways the old models never accounted for. This metal is no longer just jewelry and coins. It's infrastructure. It's energy. It's electronics. It's data. It's the nervous system of the modern world. Once silver goes into a solar panel, an EV, a server, or a medical device, it doesn't come back. It's consumed, dispersed, locked away in forms that are economically unrecoverable. That means the above-ground stockpile everyone assumed existed doesn't. It was used. Quietly, gradually, invisibly, and now the bill is due. The overnight gap to 75 is the market's first honest response to that reality. But here's the part most people don't understand yet. Gaps are not endpoints. They are invitations. They invite panic. They invite forced buying. They invite cascades. Because above 75, the market structure changes completely. Every short position that survived below that level suddenly finds itself underwater. Not slowly, instantly. Margin requirements spike. Risk managers wake up to screens flashing red. Algorithms that were calibrated for gradual movement suddenly face discontinuity. And when algorithms meet discontinuity, they don't think. They react, they buy, they cover, they chase. That's how waves are formed, and this is why the $100 level is no longer a target. It's a consequence. Markets don't move from 75 to 100 because someone predicts it. They move there because the path of least resistance suddenly points straight up. When liquidity disappears on the sell side, every incremental buy order has outsized impact. This is how silver moves when it finally breaks free from its paper cage. You can already see it in the way price behaves now. Dips don't last. Pullbacks are shallow. Every attempt to push silver back down is met with immediate demand. Not speculative demand, but structural demand. Industrial users hedging future needs. Institutions scrambling to secure exposure before the next repricing. Funds reallocating away from assets that suddenly feel fragile. And all of this is happening while the mainstream narrative remains calm. That's the most dangerous phase of any market move, because by the time the headlines catch up, the easy gains are gone. The orderly buying is over. What remains is urgency. Think about what happens when silver prints 100 on a screen. Not gradually, not after months of buildup, but suddenly after a series of gaps that leave traders disoriented. That number won't just represent price, it will represent failure. Failure of pricing mechanisms, failure of supply chains, failure of the assumption that paper claims are interchangeable with physical reality, and when that realization spreads, it spreads fast. Because silver sits at the intersection of finance and industry. When its price breaks, it sends shockwaves in both directions. Manufacturers face rising costs and shrinking margins. Financial players face losses they never modeled. Governments face inflation pressures they can't easily suppress. No one escapes a silver shock. That's why the overnight gap matters so much more than any chart pattern or technical signal. It's a behavioral tell. The market is no longer confident it can meet future demand at yesterday's prices. And once confidence is gone, control follows it out the door. This is how the unstoppable wave forms, not as a straight line, but as a series of realizations. Each gap higher forces new participants to reassess their assumptions. Each reassessment brings new buyers. Each new buyer pushes price into zones no one prepared for. You're not watching speculation anymore. You're watching repricing. And repricing doesn't ask permission. It doesn't wait for consensus. It doesn't care about forecasts. It simply moves until the new reality is fully reflected in price. Silver at 75 is the warning shot. Silver at 100 is the confirmation. And what comes after that is a conversation the market hasn't even started having yet. For now, all you need to understand is this. Overnight gaps don't happen at the beginning of stories. They happen when the plot has already turned and the audience just hasn't noticed yet. The wave has started moving, and waves don't stop because people aren't looking. And here is where the psychology shifts, quietly at first, then all at once. Because the moment silver gaps like this, every participant in the system starts asking a different question. Not, is silver going higher? But what happens if I don't ETF silver when everyone else realizes what S happening? That question changes behavior instantly. Industrial buyers don't think like traders. They don't care about charts or momentum. They care about continuity, production schedules, contracts, deliverables. If you need silver 6 months from now to keep a factory running, you don't wait for pullbacks after a gap like this. You secure supply, even if it hurts, especially if it hurts. That's the first invisible wave of buying most people never see. It doesn't show up as hype. It doesn't tweet. It doesn't celebrate. It just absorbs supply day after day, quietly tightening the market further. Every ounce locked into long-term contracts is an ounce that will not come back to market during the next price spike. At the same time, something else begins to fracture. Confidence in paper exposure. For years, institutions were comfortable owning silver synthetically. Futures, swaps, unallocated accounts. All of it assumed one thing. If needed, conversion to physical would be possible at a known price. But an overnight gap destroys that assumption. Because a gap is proof that price discovery failed. That means there was no orderly market at the previous level. No two-sided trade, no balance, just absence. And absence is terrifying to risk managers. Suddenly, compliance teams start asking uncomfortable questions. What happens if our counterparty can't source metal? What happens if delivery is delayed? What happens if settlement terms change? These are not theoretical questions anymore. They are immediate operational risks. So institutions begin to rotate, not out of silver, but out of paper silver. They start demanding allocated positions, physical backing, warehoused metal, and that shift alone can drain the system faster than any retail frenzy ever could. Because the paper market is built on leverage. For every ounce of real silver, there are dozens, sometimes hundreds of claims. As long as those claims remain abstract, the system holds. But the moment too many people want the same thing at the same time, the math breaks. That's when prices don't rise smoothly. They jump, and that jump feeds on itself. Short sellers feel it first. They always do. Some of them are speculators, betting that silver would stay contained. Others are hedgers who assumed volatility would remain manageable. But after a gap, volatility assumptions are worthless. Risk models explode, margin calls arrive without warning. Now imagine being short silver and waking up to a market that skipped several dollars higher with no liquidity in between. You don't get to exit gracefully. You buy at whatever price is available. And when many shorts rush for the exit simultaneously, they don't create supply. They create demand, aggressive demand, urgent demand, price-insensitive demand. This is how squeezes begin, not with excitement, but with fear. And fear is far more powerful than optimism. At the same time, long-only funds that ignored silver for years suddenly have a problem. Their benchmarks don't include it meaningfully. Their models underweight it. Their portfolios are exposed to inflation, currency debasement, energy transition risk. But they have almost no silver. After a gap like this, that omission becomes visible. Investment committees start having emergency meetings, not because silver is exciting, but because it's suddenly embarrassing not to own it. Career risk replaces market risk. No one wants to explain why they missed the most violent repricing in the commodity complex. So they start allocating, not aggressively at first, just enough to have exposure. But in a market this tight, even small allocations matter, especially when they come from pools of capital measured in tens of billions. This is why the $100 wave is not driven by retail enthusiasm. Retail arrives later. The wave is built by institutions quietly stepping on each other in a market that can handle their size. And while all of this unfolds, the public narrative still lags. You'll hear explanations that don't quite fit. Analysts will blame currency moves, or geopolitics, or temporary supply disruptions. They will search for neat stories to explain an ugly reality. The silver market was mispriced, and now it's correcting violently. But corrections in commodities are never polite, because unlike stocks, you can't issue more silver overnight. You can't dilute it. You can't invent it with accounting. If it isn't there, price must rise until demand is destroyed or new supply becomes viable. And here's the part no one likes to admit. At these levels, demand doesn't get destroyed easily. Industrial demand is relatively inelastic. Solar panels don't stop being built because silver is expensive. Data centers don't shut down. Medical technology doesn't pause. Silver is too small a component in end products to meaningfully curb usage at first. Instead, higher prices get passed through, which feeds inflation, which feeds monetary instability, which feeds investment demand for silver. It's a feedback loop, and feedback loops don't stop themselves. That's why the overnight gap isn't just a price event. It's a signal that the system crossed a threshold. Below 75, the market could still pretend it was in control. Above it, every participant starts acting defensively. Defensive behavior looks aggressive in markets. It looks like buying. It looks like hoarding. It looks like refusing to sell even as price rises. That's when volatility expands upward. And once volatility expands upward, new players are forced in by design. Trend-following funds, momentum strategies, volatility-targeting portfolios, all of them are programmed to increase exposure when upside volatility dominates. They don't ask why, they just execute. So what begins as a gap driven by scarcity quickly turns into a cascade driven by structure. Structure that was never meant to handle stress in this direction. This is why calling $100 a target misses the point. Targets imply choice. This is compulsion. The market is being dragged higher by mechanisms that no single actor controls. Not banks, not exchanges, not regulators. Everyone is reacting to everyone else, and the metal at the center of it all simply isn't abundant enough to absorb the pressure. That's why the wave feels unstoppable, because it isn't powered by belief. It's powered by necessity, and necessity is relentless. As silver holds above 75, the conversation changes everywhere at once, on trading desks, in boardrooms, in procurement offices, in government agencies quietly tracking strategic materials. The same realization spreads independently. This isn't a spike. This is a regime change. And once that realization sets in, the only remaining question becomes timing. Not if 100 happens, but how fast. And speed is the one variable markets are worst at pricing. Because when speed accelerates, fear overtakes planning. And when fear overtakes planning, price overshoots. That's how waves break. Not gently, but suddenly. And speed is exactly what begins to change next. Because once a market accepts a higher range, it doesn't just move up. It starts skipping steps. The pauses disappear. The pullbacks get shorter. The time between price discoveries compresses. What used to take months now takes weeks. What took weeks now happens overnight. That's when people start feeling disoriented. They look at the chart, and it no longer makes emotional sense. Old resistance levels don't behave the way they're supposed to. Psychological numbers don't slow the move. Every time someone expects exhaustion, the market answers with another push higher. This is not because silver suddenly became exciting. It's because silver suddenly became urgent. Urgency changes how humans and machines behave. It shortens time horizons. It removes patience. It turns "I'll wait" into "I can't wait." And when enough participants reach that conclusion at the same time, the market enters a phase where price stops being negotiated and starts being discovered. Discovered brutally. This is the phase where stories start to matter again. Not narratives crafted by analysts, but stories people tell themselves in order to act. Stories like, if I don't buy now, I may never get another chance at a reasonable price. Or, this move feels uncomfortable, but not owning silver feels more dangerous than owning it. That shift is subtle, but it's everything. Because fear of loss is stronger than fear of volatility. As silver stabilizes above 75, even briefly, something remarkable happens. The people who waited for confirmation get it. The breakout crowd arrives late, but in size. They don't care about fundamentals or supply chains. They care about validation, and now the chart gives it to them. Higher highs, higher lows, gaps that don't fill, so they enter. At the same time, early buyers who might have taken profits hesitate. Why sell something that keeps refusing to come down? Why exit a market that seems to punish sellers and reward holders? Selling starts to feel foolish. That's when liquidity dries up completely. Markets need willing sellers to function smoothly, but when sellers vanish, price becomes fragile in the upward direction. Every buy order pushes harder than expected. Every stop loss above the market becomes fuel instead of resistance. This is how acceleration sneaks in. No single day looks insane at first, 5% here, 6% there. But compounded over weeks, the move becomes staggering, and because silver spent so many years compressed, the expansion feels even more violent. It's like a spring that was held down too long. And here's the part most forecasts never account for. Volatility itself becomes a signal. When silver starts swinging multiple dollars a day, media attention follows. Commentators who ignored it suddenly need explanations. Financial news outlets begin running segments. Social feeds fill with disbelief and excitement in equal measure. That's when retail begins to arrive. Not first, never first. But when retail arrives, it doesn't bring size. It brings emotion, and emotion amplifies everything. People remember stories of missed opportunities. They remember gold in the 2000s, Bitcoin in its early years, housing before it ran away. They project those memories onto silver and feel a familiar anxiety rising. Is this one of those moments? That question alone creates demand. Not measured demand, emotional demand. And emotional demand doesn't care about pullbacks. This is where the market becomes reflexive. Rising prices attract buyers. Buyers push prices higher. Higher prices validate the narrative, which attracts more buyers. The loop feeds itself. Normally, supply would respond, but silver can't respond fast enough. Recycling increases marginally, but it's constrained. Mining can't scale quickly. Inventories are already thin. The market is forced to ration demand through price, and rationing through price is rarely gentle. This is when 100 stops feeling distant. Not because anyone decided it should be the next level, but because nothing meaningful exists between where silver is and where sellers might finally feel compelled to part with metal. Price zones that were never tested on the way down now need to be tested on the way up. And testing happens fast, when nobody remembers what fair value looks like anymore. Meanwhile, something even more important is happening beneath the surface. Trust is eroding. Not trust in silver, but trust in the mechanisms used to trade it. Every delivery delay, every rule change, every unusual settlement adjustment reinforces the same suspicion. Paper representations are not the same as physical reality. That suspicion doesn't need to be proven to be powerful. It just needs to exist. Because once enough participants believe that holding metal is safer than holding promises, behavior changes permanently. People stop lending metal. They stop leasing it. They stop selling forward. They hold. Holding removes supply. Removing supply increases volatility. Increasing volatility accelerates price. And accelerating price deepens mistrust. It's another feedback loop, and it's far harder to break than people realize. Authorities may try to calm things down. Statements will be made, explanations offered. But words don't add ounces to the system. They don't create liquidity. They don't meet industrial demand. At best, they slow sentiment for a day or two. At worst, they confirm fears that control is slipping. Markets are perceptive like that. They can sense when confidence is performative instead of real. That's why every attempt to suppress volatility at this stage tends to backfire. The harder the pressure, the more energy builds beneath the surface, and when that energy releases, it does so violently. That's when you see days that make no sense to anyone who hasn't been watching closely. $10 moves, intraday swings that would have seemed impossible just months earlier. Headlines scrambling to keep up with numbers that feel surreal. And through it all, the metal itself remains indifferent. Silver doesn't know it's at 75 or 90 or 100. It doesn't care about predictions or debates. It simply reflects the balance or imbalance between demand and supply. Right now, that balance is breaking. The reason the $100 wave feels unstoppable is because it isn't being driven by belief alone. It's being driven by structure, necessity, and fear layered on top of each other. Remove any one of those, and the move slows. But all three are present now. Structure is forcing buying. Necessity is locking in demand. Fear is preventing selling. That combination is rare, and when it appears, it doesn't announce how far it will go. It only announces that the old range is gone forever. People will argue later about whether 100 was justified. They'll debate models and assumptions and alternative scenarios. They always do, but those debates only happen after price has already moved. Right now, the market isn't debating. It's acting. And action, once it reaches this stage, rarely pauses long enough for latecomers to feel comfortable. The wave keeps moving, not because it wants to, but because there's nowhere else for it to go. And those who understand that are no longer asking when it will stop. They're asking how to stay afloat while it passes. And staying afloat becomes the quiet obsession. Because once a market reaches this phase, participation stops being optional. Even those who try to ignore it feel the pressure indirectly, through higher costs, through currency weakness, through headlines that suddenly feel closer to home. Silver doesn't exist in isolation anymore. It starts bleeding into everything. That's when the realization spreads beyond markets. Manufacturers begin rewriting contracts. Governments quietly reassess strategic reserves. Financial institutions review exposure they didn't even know they had. Pension funds discover they're indirectly short silver through structures built years ago. No one planned for this environment because it wasn't supposed to happen this way. But it did, and now the system has to adapt in real time. This is the moment where speed becomes frightening. Because adaptation takes time, and markets don't wait. When silver continues to gap and hold, something subtle but powerful changes in the background. Price stops being a signal and becomes a warning. Every higher print is a reminder that delay carries a cost. And the longer someone waits, the more expensive that delay becomes. That's when hesitation turns into regret. You can see it in the way buying behavior evolves. Early on, buyers scale in carefully. They test the waters. Later, they stop testing. They simply enter. Size increases. Orders become less precise. Market orders replace limit orders. The priority shifts from price to participation. I just need to be in. That sentence marks the final psychological transition. Because when enough participants adopt that mindset, the market becomes unanchored. Anchors, like valuation, historical ranges, and comparative analysis, lose relevance. They don't disappear intellectually, but emotionally they no longer matter. Emotion drives execution. This is why volatility expands so dramatically near the top of major moves. Not because fundamentals vanish, but because urgency overwhelms restraint. Silver hasn't felt urgency like this in generations, and urgency is contagious. Every new high forces a recalibration. People who were comfortable at 75 become uncomfortable at 85. Those who swore they would never buy above 90 feel compelled when 95 flashes on the screen. The fear shifts from, I might lose money, to, I might miss something historic. That fear doesn't show up on charts, but it drives them. Meanwhile, sellers remain scarce. Why sell an asset that is clearly being repriced upward in real time? Why exchange something tangible for currency that is visibly losing purchasing power? Every argument for selling feels weaker by the day, and every argument for holding feels stronger. So supply stays locked. This is when price overshoots, not because demand explodes, but because supply refuses to respond. It's a subtle distinction, but it matters. Demand can cool. Supply refusal is harder to fix, and the higher silver goes, the more that refusal hardens. Holders begin thinking in different units, not dollars per ounce, but ounces per future obligation. They imagine a world where silver is scarce not just in price, but in availability. That imagination alone reinforces holding behavior. This is how markets detach from linear thinking. Linear thinking says higher prices cure shortages. Nonlinear reality says higher prices can expose shortages faster than they resolve them, especially when production can't scale and inventories are already thin. So as silver pushes closer to 100, the market enters a strange calm between storms. Pullbacks are shallow, consolidations are brief. It feels like the market is catching its breath, but in reality it's absorbing pressure, like a wave pulling back just enough to gather more force. That's when people misread the moment. They say, maybe this is it, maybe it's done. But nothing fundamental has changed. Demand is still there, supply is still constrained, trust in paper claims is still eroding, and every attempt to suppress volatility only adds tension. The system hasn't reset, it's compressing, and compression always releases. This is where acceleration can turn violent. Not emotionally violent, but structurally violent. Sudden revaluations, overnight moves that feel unreal. Price jumps that invalidate entire strategies in a single session. Risk models that simply stop working. That's when the phrase disorderly market starts appearing. But disorderly doesn't mean chaotic. It means the old order no longer applies. And when the old order breaks, a new one establishes itself quickly. In silver's case, that new order is one where physical availability dictates price, not financial engineering, where ownership matters more than exposure, where leverage becomes a liability instead of an advantage. Those shifts don't reverse easily. Even if price eventually cools, the memory of this phase lingers. Participants remember what it felt like to not be able to buy when they wanted, to see price jump without warning, to realize assumptions they relied on were wrong. That memory permanently alters behavior, which is why the aftermath of a move like this is often just as important as the move itself. Because even after the wave crests, the baseline never returns to where it was. Trust doesn't fully recover, participation patterns change, and silver's role in portfolios, industries, and policy discussions expands. The metal graduates from afterthought to cornerstone. That transition is irreversible. So when people talk about 100 as if it's the end, they misunderstand the nature of regime changes. 100 isn't a finish line, it's a milestone, a marker that says the old world is gone. After that, the conversation shifts from how high can it go to what does this mean for everything else? And that's when silver stops being just a market. It becomes a message about scarcity, about leverage, about the limits of paper systems in a physical world, about what happens when reality finally asserts itself after years of delay. That message doesn't fade quickly, it echoes. Through currencies, through bonds, through equities, through geopolitics, through energy policy, through everyday prices people pay without ever thinking about silver directly. That's the quiet power of this moment. Most people won't remember the exact day silver gapped to 75. They'll remember the consequences that followed, the sense that something shifted and never quite shifted back. And by the time the wider world fully understands what happened, the wave will already have passed its most dramatic point. That's how it always works. The market moves first, understanding comes later, and right now, the market is speaking louder than it has in decades, not with words, but with gaps, with speed, with refusal to go back. This is not noise, it's signal. And signals like this don't appear unless the system beneath them has already changed. The wave is still moving, and it hasn't finished showing what it can do. And what makes this phase especially dangerous is how normal it can feel at first. People adapt quickly. A price that once seemed impossible becomes familiar in days. Screens update, charts rescale, commentators adjust their language. What was shocking last week becomes the new reality this week. That normalization masks the scale of what's actually happening. Because underneath the surface, stress is accumulating. Not emotional stress, but mechanical stress. Every system built around silver pricing, contracts, hedges, supply agreements, financial products, was calibrated for a very different world. A world where volatility was contained, where price discovery was orderly, where liquidity could be assumed. That world is gone now. And when systems designed for calm are forced to operate in turbulence, they don't fail all at once. They fail at the edges. Quietly. One adjustment here, one exception there. A temporary rule change, a one-time settlement tweak. Each adjustment seems small in isolation. Together, they tell a story of strain. This is when participants begin to sense fragility. Not necessarily collapse, but fragility. The feeling that the market is being held together by decisions rather than by natural balance. And when markets feel managed instead of organic, confidence erodes further. Confidence is everything. Once confidence is questioned, participants stop optimizing for profit and start optimizing for safety. Safety means fewer risks. Fewer risks mean less lending, less leasing, less willingness to provide liquidity. Liquidity providers step back, and when liquidity providers step back, price becomes jumpy. This is where the moves get sharper. Silver doesn't glide higher anymore, it lunges. It snaps back briefly, then lunges again. Each lunge leaves behind a gap, unfilled, unresolved, uncomfortable. Those gaps act like scars on the chart, reminders of moments when the market couldn't function normally. And scars change behavior. Traders stop fading rallies. They stop shorting strength. They stop assuming mean reversion. They've been punished too many times for it. Instead, they flip, they chase, or they step aside entirely. Stepping aside removes even more liquidity. So the market becomes thinner, more sensitive, more reactive. This is why moves start happening at strange times. Overnight, during low-volume sessions. On no news at all. The market no longer needs a catalyst. The imbalance itself is enough. People look for explanations anyway. They always do. They point to interest rates, to currencies, to geopolitics, to energy prices. But those are just lenses through which they try to understand something deeper. The system is repricing risk, and silver is at the center of it. Because silver exposes contradictions. It's both monetary and industrial, both investment and consumption, both ancient and modern. When its price destabilizes, it highlights tensions that were already present but easy to ignore. Inflation versus growth, debt versus productivity, promises versus physical reality. That's why silver moves often feel outsized compared to their triggers. It's not responding to one thing, it's responding to everything at once. And as the wave continues, resistance shifts from external to internal. People don't resist the price anymore. They resist their own disbelief. This can't be sustainable. This has to correct. This doesn't make sense. Those thoughts surface repeatedly, especially among experienced participants. Experience teaches caution, but experience can also blind. It anchors people to what has been, not to what is becoming. Markets don't reward comfort, they reward adaptation. And adaptation at this stage means accepting that the old framework is broken, that valuation metrics based on past regimes no longer apply cleanly, that price is not a prediction, it's a diagnosis. Silver at these levels is diagnosing a system under pressure. The higher it goes, the clearer that diagnosis becomes. That's why reactions become more extreme, not just in price, but in commentary. You'll hear confidence on one side, disbelief on the other, very little neutrality. Because neutrality requires stability, and stability is precisely what's missing. This polarization feeds volatility further. Bullish participants dig in, convinced they're witnessing history. Bearish participants become louder, more urgent, warning of bubbles and crashes. The debate intensifies, but the market ignores it. It keeps doing what imbalance tells it to do. Move. And movement itself becomes the message. At some point, even the skeptics stop arguing, not because they're convinced, but because arguing is exhausting when price keeps invalidating the argument. Silence replaces skepticism. Silence is dangerous because it removes the last emotional brake on momentum. That's when you get the final surges, the days that feel unreal even in hindsight, the kind of days people talk about years later. Not because they made money, but because they realized how quickly assumptions can dissolve. Silver doesn't need to reach a specific number to deliver that lesson. It only needs to move fast enough to break mental anchors. 100 is powerful, not because it's round, but because it's symbolic. It's a line that separates "this is interesting" from "this is systemic." Once crossed, it forces everyone, investors, industries, policymakers, to acknowledge that something fundamental has changed, and acknowledgments carry consequences. Policy responses, strategic stockpiling, regulatory scrutiny, corporate hedging, all of it feeds back into the market, sometimes dampening moves, sometimes amplifying them, rarely neutral, but those responses come after the fact. They don't prevent the wave, they respond to it. That's the mistake people make when they assume control will reassert itself easily. Control requires foresight. What's happening now is reaction. Reaction is always late, so the wave continues until enough pressure is released. Through price, through demand destruction, through substitution, or through some external shock that resets expectations. No one can say exactly which mechanism will dominate or when. But one thing is clear, the journey to that point is not smooth. It's volatile, emotional, disorienting, and for those inside it, time feels distorted. Days feel long, weeks feel short. Prices that once took years to reach appear in months. That distortion is another sign of regime change. Because when markets change regime, they don't just change numbers. They change perception. What once felt impossible becomes normal. What once felt risky becomes necessary. What once felt safe becomes questionable. Silver is doing that right now, quietly for some, loudly for others, but unmistakably. And as the wave approaches its most visible phase, the most important thing to understand is this: the market is no longer asking whether silver deserves these prices. It's asking what breaks if it doesn't have them. That's a very different question, and questions like that don't lead to gentle answers. They lead to movement, relentless, uneven, uncomfortable movement, the kind that reshapes markets long after the charts stop making headlines, the kind that leaves behind a new normal, whether anyone asked for it or not. The wave is still unfolding, and its final shape has yet to be revealed.